So investing became so much easier once I learned these four concepts. Now I can look up any stock and within a few minutes be able to tell really quick whether it's a good company or a bad company and whether or not there's an opportunity to make money in that stock. And I picked all this up from 10 years of working in a career on Wall Street. I was a research analyst at Bank of Montreal Capital Markets. It's an investment bank in New York. And so now I help educate and mentor new investors, which I love. And so let's jump right into the four concepts that you can apply today, and that'll make investing so much more easier and enjoyable for you. So number one is to study stocks, not investors. Now I get it. It's really tempting to want to spend a lot of time reading about different investors rather than the actual stocks. It's kind of fun. You know, I have George Soros's book. I have Ben Graham's Intelligent Investor, Warren Buffett's favorite book. And I get it because you want to understand whether or not there's like a secret formula, and it's also useful to understand the philosophies, but none of it really will make sense until you start looking at actual stocks. So it's a bit like you'll only notice a diamond if you spend a lot of time looking at a lot of dull, boring looking rocks, right? And then you notice that really shiny one and you realize, oh, it's a diamond. So it's just the same way with stocks. You have to look at a lot of really bad stocks, and then you start to notice the ones that stand out, which are the really good companies. So the best company that I found when I was working as an analyst was MSCI. It's an index company that's used for investors. And that went up 700% over the 5 years when I started recommending it. And that was actually really easy to spot. And the reason why that was is because I spent a lot of time looking at a lot of crappy companies. So companies in the staffing and education space, like they were really low profit margins. They were very volatile, like temporary staffing levels were always changing quarter to quarter. Schools were closing down. Each semester, it was just like a guess of whether or not they would get new students. So you see it in the numbers and they were just a mess. And then all of a sudden I see MSCI and it's like a dream, right? I see the revenues are growing at like 10% steady every single year, every quarter, because investors need to use that index data to build products, and they subscribe to the data. So it's very recurring and resilient. And the profit margins were 70%. Now, that number might not resonate with you right now until you look at a bunch of stocks and realize that a lot of companies, maybe they'll get to 10% profit margins. Maybe tech companies will get to 20%. That's really good. So 70% is insane. It's very clear that that was a really good company. So the more companies that you look at and learn about, it's more like you start to build up these mental patterns in your head. And it just becomes really easy to see a great company stand out. So I recommend when you're first starting, if you do want to read investment books, is first to go for books that are written by investors with a lot of case studies. So for example, Joel Greenblatt, You Can Be a Stock Market Genius, great book. You know, Peter Lynch, his whole book is filled with case studies. If you want to read mine, it's Henry Chien, whole bunch of case studies as well. So the point is, when you read through actual business case studies, you get a general understanding and get ramped up on businesses and markets. Now then, set yourself a goal. Study 10 stocks. Now, I don't mean look at just the stock chart. I mean, study the business. So I mean, look at the financials, look at the investor presentations. You can find transcripts of it, or read the business part of the 10K just to understand what the business is like. And I guarantee you, if you look at 10 stocks, one of them will look pretty good. And if not, statistically, 4% of all stocks will drive 99% of the entire wealth creation of the market. That's what's been happening over the past 100 years in the US market. So that means 1 out of 25 stocks will be amazing. And I recommend that you start looking at businesses that you're just naturally interested in, whether that's cars or chips or retail or whatever. Just start learning about these businesses. Study 10. If you don't see any good ones, get to 25. And I guarantee you'll start to spot some really good companies. Now, number 2 is to learn to read financial statements. So forget the trading indicators like RSIs and looking for chart patterns like double tops or whatever in stocks. Like just stop that for now, because it's going to make you go crazy. I know it did for me, because when I was doing that, like I would look for a support level or a resistance level, and I was just, pulling out my hair because I didn't know if the stock was going to go up or down. especially when you're looking at like short-term charts over a past few days or weeks. See, because prices in those time frames and with the chart, they're just reflecting liquidity. What that means is they're just reflecting the buying and selling of people in the marketplace. It's the traders that are setting the price. And that price is trying to anticipate the flows of buy and sell orders, as well as incorporating different information that's coming out. That's why it's more volatile, because the price is constantly adjusting for new information and also having to adjust for the balance between buying and selling orders. So if you're only watching the price, it's a bit like if we put on a basketball or football game on, and instead of watching the actual game, you just have a computer on the side reflecting the odds, the betting odds for each team, play by play, and using that to watch the game. So you're just watching other people's opinions. And some people make money on that for sure. I was not able to make money that way, and I imagine neither do you, or it just doesn't make sense. That's why you're probably here. So instead, just learn to read the financial statements, learn to research companies. And then when you look into a business, ask yourself these questions. How does the company make money? Why is it growing? What are the profits like? How does it compare to its competitors? Answer these, and you're going to be well on your way to understanding what's actually moving the stock price, which is the business itself. Because there's a saying on Wall Street, is that price follows earnings. So for example, if I'm going to put up Tesla as a company that you know, it's really clear that Tesla's, as a business, the earnings of the company are generated by car deliveries. Now this stock really took off after 2020, right? Like it's gone up 100 times since then. So why is that? Well, it becomes very clear when we just look at the financial statements. So I'm going to pull up the highlights over here, pull up the annual statements, and there's one thing that you'll notice right away. So in 2020, that's when the company started to generate a positive profit. So you can see that the net income turned positive there. Now, why did the stock move up so much? Because you can see the past 4 years, it had real troubles making any profit on its company. So there was a lot of concern on whether the company could actually, at the end of the day, make money selling cars. So once that turned positive, you had a bunch of funds buying the stock, and it's literally a requirement for a lot of these institutional big fund managers that the company must have positive earnings in order to buy the stock. So once you understand the business's earnings, and with Tesla, it's because they were finally having a cost structure that was profitable. Once you layer on top the fact that they got more car deliveries because those cost structure was relatively fixed, that's how profits went up so much. So once you understand the business's earnings, you can really start to understand why the stock is going to move up. Now, number 3, you always need to think one step ahead. The market is always pricing the future. So when you drive, you can't drive by looking at the rear view mirror. That's what Peter Lynch would always say. And by the way, if you don't know who he is, I've mentioned him a few times, is that he was a top performing fund manager in the 90s, and he looked at thousands and thousands of stocks, and he did really well. So you have to remind yourself constantly what's going to happen next. Once you get into the habit of doing that, right, you're looking forward to the road that you're driving on and what's coming next, then you start to get to understand what's going to make the stock price move. So for example, when you see a company doing really well, like NVIDIA, for example, they got a new product launch, like the Blackwell platform's got all these new AI chips. You got to train yourself to think, okay, what's that going to do to the future earnings of the business? So if Microsoft is going to spend a lot of money on AI and their CapEx, other tech companies are going to be investing in these chips as well. Where is that money going? Which companies are going to have their earnings benefit from that spending? Then as you get better at actually doing that and thinking through that, you can actually start to put a number behind it. You can start to estimate, okay, so I think that this company is going to grow its earnings by X percent. And then it becomes really obvious you want to own that stock, because if that company is going to improve its earnings by X percent, it's very likely the stock price is also going to grow by that percentage. And I realized this when I was first working on Wall Street, is I was looking at a company, Robert Half, that was the first company that I remember. It's a staffing company, and we cover the earnings reports, right? So I imagine going in, I'd probably be spending a lot of time analyzing the financials, talking to investors about what happened with the quarter. Nope. I come in, earnings reports drops. First calls that I get after it's released are, what's the guidance of the company, right? Every single time I got a question, what is the guidance for the company? Meaning, what's the company's forecast for the next quarter? And then what are those numbers going to do to your estimates? Meaning, where do you think analyst estimates are going to go as a result of that new guidance? Because all these investors have been trained to look in the futures, because that's what drives the stock price. And that's how investors make money. So example here, so you can see what that looks like in practice. This is the company MSCI. So this stock, you can see right after its 2Q earnings report dropped about 20%, right? Like in April 2024. And so what happens when you look into actually what's going on in the business is they lost a contract. And so growth slowed for subscription sales, and obviously the stock price reacted to that. Now, when that happens, if a company sort of loses some business, you have to ask yourself, okay, so is this temporary or is this permanent? Like, what's coming next? And then is this valuation now reasonable? And so I did the research. I looked at other index companies, and I realized a lot of companies also lost contracts because there was a big merger in the space between two banks. And so the problem wasn't anything to do with MSCI. And because I understood the company, and management was also saying over the next few quarters, growth is going to pick up, I trusted them. And I think the long-term trend is intact. People are using indexes everywhere with ETFs and index funds. And so I believed that earnings growth would recover. And I had a sense from the research that the company could grow at least 15% in earnings each year. And then the multiple also got down to about 32 times. I guess I can show you that too. And then the multiple also got down to about 30, 31 times. Now, that's obviously not a cheap range for the stock, but for MSCI, that was kind of at its low end of the range. So assuming it's the same company, that's a reasonable valuation. So I want to own this company long term, so I buy it. And so then what happens over the next couple quarters? Let's go back to the stock chart. So you can see over the next few quarters, as they reported their earnings, the growth did recover. They had a stronger subscription growth. Some of the other businesses started to perform better. And so it's just back on track. And then what happens? You get like an easy 25% gain in just a few months, right? So that's how you can start to, when you think ahead, you can start to make money with stocks. Now, next time you look at a stock chart, I highly, highly recommend that you do something like this. So you're obviously going to pull up the price chart. So that's the green line here. And what I would suggest you do, and I have this on Koifin, is just pull up the EPS or the next 12 months earnings per share estimate, because that'll show you what analysts are expecting for the coming year. And that's how you can start to see what the company is doing and how its earnings are changing with the stock price. Then look at the company's recent earnings. So don't just stop there. Find out the guidance for the next earnings for the coming year or for the next quarter. That data point will give you the best sense of the direction of the future earnings of the company, and then also help you anticipate the change in the stock price. So is this starting to make sense to you? Let me know in the comments and start taking action on this right after this video. So fourth concept, accept and manage risk. So this might be more specific to me, but I figured if you're interested in investing, you probably felt the same way that I was when I was starting out, which is I had a real problem taking risk, right? I would buy a stock and I would just worry about it going down. And then if it did go up, I'd be worrying about when should I take profits. See, the problem is I had all this baggage from coming at it from a trading perspective. And so you might feel the same at this point, right? Or maybe you're at a point where you're just throwing money at stocks and you're just gambling or hoping it will go up. So the best way that I found to accept and understand risk is to remind myself that this is a company that I'm buying. You can also anticipate what can go wrong with the stock by, one, just looking at history, or two, just looking into the risk section of the 10K. And you should be doing this each time before you invest in a company, because they'll tell you exactly what can go wrong with the business. And then once you understand the risk, you can estimate it. So for example, with NVIDIA, this is the chip company. Well, what's the risk of investing in NVIDIA right now? Well, there's obviously a risk of a decline in chip spending, because chips move in cycles if you start to look at the history of these products. And it's usually based on whatever the latest technology product is, whether that's personal computers, PCs, or cell phones, and now it's data centers. And so what happens is when those products start to get maxed out, people start buying less of those chips, and that's why it creates a decline in the stock. So you notice that in 2020, you see that decline, also 2014, and also 2009, 2010, right? So those are the periods when the chip cycle is in a down cycle, and there's a decline in chip sales because the tech products aren't being bought as much, so there's less need for those chips. Companies are spending less to buy those chips. So based on that history, you could estimate, okay, NVIDIA, in that scenario, their sales might drop 10% or so based on its history. The valuation will also drop The price to earnings ratio will probably get down to about 15 times like it has in history. So that's your downside. You just estimate the decline in earnings, estimate the decline in valuation. But it's not just what's your risk at that point. If you believe that NVIDIA will continue to make chips for each subsequent technology product in the future, when we do get into the down cycle where there's a chip decline and we're about to move on to the next product, that is also mentally the time period where you should remind yourself, like in 2023, that that's when the risk has already been priced in, and that's the time for you to start buying the stock because you're positioning yourself for that next move for the next product. The point is you accept it. That's your risk, and you be prepared for it. And then if you're uncomfortable with it, you just size the position down until you have a risk threshold or expected loss that you're just comfortable with. Or you can just be patient and wait for a stock to come down to a better valuation at a price that is already reducing your risk because the price has already priced in whatever down cycle in the chip sector is for the company. But remember, this is a game of risk taking. You have to take risk in order to get the returns. Your advantage is that you can pick the risk that you want. Understand risk, estimate it, and accept it. And remember, no matter what's going on, whether it's some new virus, whether it's trade wars, tariffs, whatever, the market's always going to move and gyrate. The prices are like that. They're volatile. They're always pricing in different types of information. But remember what you're buying. You're buying a share of a business. So in the end, it's about the corporate profits. The profits are what drives the stock. So no matter what the news says, no matter what the market's doing, the profits of that company will ultimately determine the value of the stock in the long run. So always remember that. And just to wrap up, I think one of the biggest problems that makes investing really difficult for people when they start out is most people have this weird conception that investing, or not weird, so most people have this conception that investing in stocks is just purely luck. It's just 100% based off chance. There's no decision making involved. And the second thing they believe is that you can't do it. Like it's been drilled into your head over and over how dumb you are, that nobody can beat the market, there's efficient market hypothesis, whatever, right? So you're trained to believe that it's all just luck, right? And so that what does that mentally do to you? Think about it. If you believe something is 100% based off chance and that there is no edge, there's no way to make money with good decision making, what is that? That's just basically gambling. So then you're going to treat it like gambling. And that's what a lot of people, they don't even bother looking at earnings, looking at the business, looking at the valuation. They just follow price trends. They just throw money at and place bets because they think it's gambling, right? Because of that mental barrier. So stop doing that. You're just making it harder for yourself. The more you understand that you're buying a real business, there's real economic principles going on based on how companies are making money, i.e. earnings, and how that grows the company's value. And the market price is just pricing in different outcomes. And your job is just to forecast earnings and value the companies. The sooner you internalize these concepts, I guarantee the easier it'll be to actually identify great companies, again, by studying companies and finding good bargains, which just comes from understanding the earnings and understanding the valuations. Then you make better decisions, and then you make money investing your money in stocks. So let me know in the comments if this has been helpful. Keep studying companies. I'm rooting for you, and I will see you in the next video.